Hi everyone, it's a great honor and pleasure to present our work on explainable AI applied to the multi-agents environment of financial markets. It's a joint work between AI for Alpha, Ohana Capital and Dauphine University, involving a team of 5 people, Jean-Jacques Ohana, Steve Ohana, Eric Benhamou, David Saltiel and myself, Beatrice Guez. I will leave the floor to Eric to present the results of this collaboration.
Thanks, Beatrice, for this nice introduction. Financial markets are a typical case of multi-agent environment. If we take, for instance, the S&P 500 and look at interaction, we can distinguish at least 3 types of agents. Market agents that react very strongly to news, like the sharp decline when the COVID lockdown was announced, or the weekly rise for the Trump or Biden election. Central bank, like the unlimited support and corresponding massive quantitative easing in March 2020 after the COVID crash, or in the end of 2018, the interest of rates, which causes a sharp decline of equity stocks. Government action, like when the Trump administration renegotiated the NAFTA, or the recent trade war with China or the Trump administration. The fuel of machine learning models is data. To be able to predict regime, we use many features. Risk aversion, such as equities, currencies, and commodities implied volatilities, or credit spread or VIX forward curves. Price indicators, such as return Sharpe ratio of major stock markets, and distance to their long-term mean. Financial metrics, such as sales growth, price-earning ratio, forecast over the 12-month forward. Macroeconomics indicators, technical indicators such as market breadth or put-call ratio, and last but not least, rates like the 10-year, the 2-year use rate, or the break-even inflation information. This information is very powerful as it scans across multiple dimensions with more than 150 features. David will explain you now in greater detail the model.
Our methodology is divided into 4 distinct steps. As explained by Eric, we firstly feed the model by more than 150 features. Using all raw features would add too much noise in our deep model and would lead to biased decision. We thus need to select or extract only the most meaningful features. We then remove the features into 2 distinct steps. Based on gradient boosting trees, we rank the features by importance or contribution, and we then pay attention to the severity or multicollinearity in ordinary least square regression, using some VIF methods, like variance inflation factor. We then use this quantity of data to derive a daily crash probability. We assume that there are 2 equity market regimes. A normal regime where an asset manager should be positively exposed to benefit from the upward bias in equity market, and a crisis regime where an asset manager should either reduce its equity exposure or even possibly short sell when permitted. This is step 3. Then the final step 4 allows us to explain and understand the reasoning of the algorithm using the Shapley values. We compare our model against common machine learning models, namely a support vector model, a random forest model whose max depth is set to 1 and burst rounds are set to 500, a first deep learning model with fully connected layers, and a second model, a deep learning model, a bit more advanced deep one consisting of 2 layers, a 64 nodes LSTM layer followed by a 5% dropout, and then followed by a 32 node dense layer with a single node and sigmoid activation. We train each model using either the full set of features or only the filters one as just explained before. We provide then the performance of these models according to different metrics such as accuracy, precision, recall, F1 score, and so on. The gradient boosting decision tree with feature selection is, as you can see, superior according to all metrics and outperforms in particular the deep learning model based on LSTM, confirming the consensus reached in the machine learning community as regard classification problem in small and imbalanced data sets. Concerning the ROC curves, the two curves are well above the blind Guez benchmark that is represented by the dotted red line. This effectively demonstrates that these two models have some predictability power. Now I will leave the floor to Jean-Jacques to open the box and explain the results.
Shapley values are derived from the work of Nobel Prize laureate Shapley in cooperative game theory. They provide a decomposition of the logged probability on the features. Before the crisis, bullish factors prevailed, notably the low volatility regime, positive economic surprise, and a constructive cycle on multiple expansion on equities. However, just before the COVID market meltdown, bear market factors take over with the fall in interest rates, the sharp deterioration of equity indices, and base metals price action, reflecting a downturn in the economic cycle. As a conclusion, gradient boosting decision tree methods are efficient to classify financial markets into normal and crisis regimes using 150 technical and fundamental features. Shapley values provide thorough explanation of the model. Further work should generalize its approach to other markets and leverage on this prediction to build a portfolio.